It's a good place to begin a conversation with our next guest, Bob Peck, of course, Barclays Chairman of Global Internet Investment Banking, joins us this morning. Bob, welcome back. Always good to talk to you.
Yeah, thanks again for having me again, and I look forward to getting back there on the desk live at some point.
Yeah, we all wish for that. I wonder if you think this brief unwind that we've seen over the past few sessions is as spooky as some, at least technicians, argue it could be, given some of the analogs to 2000 and other periods where you saw very sharp drop off of a record high. And I don't know, you drawing lessons from that?
Yeah, it's a great question. I think it's the question on everyone's mind right now. Let's level set for a second. You know, for the year so far, we just look at year to date, the S&P is up about 5%, sort of flattish to the pre-COVID highs. NASDAQ's up about 24%, up about 14% or so from the pre-COVID highs. And as you peel that onion apart, you've had growth really outperform value, up about 20% versus value down about 15%. And in the tech names, you had it led by, digital entertainment names, internet, software, all performing very strongly. And as John pointed out, the FANG M names, really bounced hard off the lows, up a good 40% or so from the lows to where we are today. So what's driving all that, right? Obviously, you got near record low inflation rates, interest rates, you've got supportive Fed, you've got a global stimulus package of over $25 trillion. So you've had a lot of support mechanisms there. And then I think we can get our next clue by what happened in 2Q. So if we look at 2Q earnings, which we just finished up, about 80% or so of the companies that reported beat earnings, right? And beat them by a good 25, 26% or so, so strong beat. What's interesting is a lot of that outperformance has not created revisions or substantial revisions into 2021 or 2022. So now let's take the valuation. Your question about are things, overblown here? Well, the S&P is currently trading about 24 times forward earnings, 2021. Now that's historically pre-COVID around 20 times. So you're up a good 4 points there. But there's a couple things I'd point out there. One, as we just talked about, investors aren't sure that the revisions have actually flown through to 2021 and 2022, maybe therefore artificially increasing that multiple, right? And then number two, if you think about COVID-resistant companies and names, the premiums on those names have gone up a good 50% or so versus non-COVID resistant, only about 10%. So you're seeing a premium for investors on these non-resilient names. Carl, if you recall, last time I was on, we spoke about this work from home basket or what our investors are calling it COVID, right? So C being the collaborative software and cloud software products and security, O being online commerce, V being videos and gaming, I being the in-home things like Peloton, Teladoc, et cetera, Indeed delivery. What's interesting, Carl, is those names from the beginning of the year up over 80%. And since I was last on the show, they've been up about 40% since late May. So it's interesting, those names continue to perform, and you see investors placing a premium on these names that are maybe not only resistant to COVID, but may even be benefiting and are seeing their growth reaccelerate.
Yeah, it's a great point, Bob. I wonder the degree to which some of these names, though, as we restock our home, we turn our living rooms into offices or TV studios, mind you, we stock up on extra consumer hardware, where that leaves demand next year. Obviously, the comps are going to be tough either way, but how much demand is sustainable once we get at least a portion of the people who are now at home going back to the office, even on a limited basis?
Yeah, it's a great question. I think a lot of these companies that are seeing this acceleration had already seen these trends happening anyway. These were trends that were long underway, whether it be online commerce or in-home fitness, delivery, all those were well underway. And I think what you saw was an acceleration because of COVID. And what's interesting is we think that this is not just a one-time blip, but something actually is going to continue from here. I believe even yesterday, one of the exchanges announced that while we will get back to true roadshows at some point, virtual roadshows are not going to be gone. There's just an efficiency there that will help augment or supplement traditional roadshows. So I think a lot of these things we're seeing, such as video conferencing, are long-term trends that are going to be sustained by just the change in consumer and in enterprise behavior.